Okay. So, again, and we're obviously we're going to get to the bottom part here too. So the idea with all this is that, what we want to know here is where is current price in relation to these key moving averages. And so over here, we got the 21 on the daily, the 8 on the daily, and then the 5 on the daily. And then in these extreme moves, we can stay far away from these for a while. So not, we're pretty far from them. But the 5 gets tested a couple times a week. So, the one thing as I'm looking at here is like, all right, we're going to start the week. I mean, obviously it was ugly, but we're also pretty far below that 5 EMA. And so I would be looking initially for signs that, if these oscillators are turning higher here, that, we could ride some up and down, remember that we're going to stair step up, stair step sideways, stair step down. And what are the ways that we can capture that? Let me get some music here.
Yeah, and we'll get to all this. So the main thing here is what we want to understand is just make sure we understand this whole idea of the moving averages and kind of why they're important and all that kind of stuff too. And you remember the goal here is that we are looking to participate in the wiggles, right? And in its simplest form, let's just call this the 21 EMA on the 30-minute chart. On its simplest form, if we get too far away from that, we're going to come down back to it. And if we get too far away from it to the downside, we're going to snap back to it. And we can sell call credit spreads on the SPX on this turn, and we can sell put credit spreads on the SPX, on this turn, and we can just do it over and over and over again, whether we're trending higher or sideways or lower. Now, obviously, if there's a strong downtrend, the idea that we sell call, but I mean, the easiest trade, I think, Friday, there was, obviously it's like a pretty stiff down day. So it's like, okay, we're not trying to catch a falling knife or anything like that. So we just want to understand, like, what's a clear signal? And that's what we're going to get to is just like, we don't want to look at something and guess. It's just like, what's a clear signal that I can take? And that's what I want to look at. So the other part of this then is that, we talked about two ways to measure this, right? So, what I found is like, again, let's just talk about the 21 EMA on a 30-minute chart is basically like, okay, well, geez, if we get about 1% away, then we want to start looking for signals that it's going to roll over. And if we get about 1% away, we're going to look for signals here. But the other question is like, okay, are there some like envelope bands that we can kind of use as a guide here? And after playing around with this, yeah, the answer is yes. And so with that, what we do is that's what these are. And now, honestly, this is kind of I wouldn't say this is a make or break part of this, but I kind of like it. And what this is this is a 1 hour chart. And of course, this is the SPX. And then these are just the Keltner channels. And they are just set at, 21 EMA in the middle. And then the ATR is 3.0. So I'm just looking for those extreme moves. And you can see that this kind of, puts a ceiling on upward price before we get that reversion back and, kind of puts a cushion down here too. And if you want that extra visual, that is a way to do that. So what I look at this is that the sandbox, it's just the concept of the sandbox, right? And if we look at this is where price is contained, then this is the lower Keltner channel, and then this is the upper Keltner channel, and and price kind of stays in between those for the most part, and that gives us kind of a nice visual as to look at that. And so what's the visual then? What does it comes down to? And again, it looks like, oh my God, it's like all these squiggly lines. But now what we can see here in one shot is like, okay, well, here's the Keltner channels. So that kind of gives us the kind of the maximum band that we're going to go to. And right now you can see we're riding that lower Keltner channel, and then we work our way back to the 21. And like, oh, we're riding that lower Keltner channel again. We work our way back to that 21 on the 30, right? And again, it's the Keltner channel from the hourly chart, but the 21 on the 30, okay? But nobody looks at that. So that's kind of what we're looking for there. So it gives you that little extra kind of a little bit of a sandbox. And you can see even when, when we got up here, kind of the same thing. It kind of peters out. So I like that. You don't necessarily have to have that on your chart or not. It's there if you would like to see it. It's it's kind of a nice reminder, kind of where we are and all that kind of fun stuff. All right. So that is the origin story and the why. And I included those moving averages and all that in there because the origin story really is about what is the sandbox for prices. And we've established that sandbox with those key moving averages from different time frames and those kind of Keltner channels that set up the sandbox, right? So now what we want to know are what are the tools essentially that say, okay, we want to be able to read the market, and is it starting to turn higher here or is it starting to turn lower here? And this is essentially the main tools, the rotation tools that we have here. And so what we want to do is kind of dive into those. So it's all about flowing with the tide. And once we've established the sandbox, right, which we've done that now with the moving averages that we're bringing in from multiple time frames, and if you want that that extended sandbox there, just kind of where those Keltner channels are. But now we want to know, like, okay, that's the sandbox. What do we look for turns? Like, when do we know? When do we have confidence that a market is turning? And so one of the things that I looked at initially that I really like, and if you guys are familiar with the squeeze, one of my favorite trades on the squeeze is simply like, oh, here's, the squeeze essentially is this compression of momentum. And then, when we release it, it's kind of like this release of energy. And that's how I use the squeeze. I've also kind of watched the histogram where it's like, okay, it's like we've got this move up here, but when the histogram rolls over, typically when it rolls over, it's going to do this anywhere from like 12 to 18 bars. You get a roll before it rolls back the other way. And so when it starts, oftentimes that can be the beginning of an extended move, right? And then you get a roll back higher. And then, here's a pretty long roll higher. And then we roll back lower. And so this is the daily chart. And, it's going to be, these bigger moves and stuff like that. But it is kind of a nice heads up as to like, oh gosh, this momentum is, is it shifting? Is it starting to roll higher again? Or is it rolling over and dying? That's the kind of stuff I want to look at there. And so while that was helpful, and I certainly wanted something that's a little bit faster and would give me a heads up. I mean, I could see, the daily chart might be rolling higher, but what is the hourly chart doing? What is the 30-minute chart doing? Are these all in sync? Are they moving together? Or is like one, what's going on there? I thought that would just make it easier. And so, initially, of course, it's like, well, let's look at, 6 time frames at once. And so if we look at this, you can see that here's the S&Ps, and there's this box on the 1-minute chart, that same box on the 2-minute chart, the same box on the 3-minute chart. Here it is on the 4-minute chart and the 5-minute chart, and of course the 10-minute chart. And then, of course, this is an eyesore, so don't worry about it. But you can see, like, oh my God, the momentum here is turning higher, and oh, the momentum here is turning higher, and 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 the momentum here is turning higher. So no surprise if the momentum on the 1, 2, 3, 4, 5, and 10-minute charts are all turning higher. You're looking at a market that's bottoming out and getting a little bit of a pop. So it's like, okay, is there an easy way to kind of look at all of this visually? And so I knew from experience that this would be impossible to track over the course of 6 different charts throughout the day. It would be hard enough for me, let alone for James, who was just brand new to trading. So I didn't, again, my whole point of this is I didn't want to make it complicated for him. But the concept really kind of grabbed hold of my brain, and I couldn't let it go. I'm like, there's got to be a way to do this. And because I think it would just make this whole simple. And that's, that's when I reached out to Eric, because he can kind of do anything like that. And so now all of a sudden, instead of looking at 6 different charts, it's like, all right, now, again, this is the 1-minute chart, and I can see the 1, the 2, the 3, the 4, the 5, and the 10-minute histograms here. And it's like, okay, great. Guess what? If they're all above 0 and ascending higher, that's 6 different time frames that are confirming this move. And typically that's when you're going to get the best moves. I mean, that's like a 3-point, 4-point move on the spiders. And then conversely, when they start to roll over, you can see that as well. And it's multiple time frames and kind of the ebbs and flows, and it kind of helps get you that. Now it looks kind of like spaghetti, right? So, initially I liked it, but I'm like, this isn't going to be that easy for James to follow. And so I was like, okay, let's look at this again. Now, in the context of, putting all this stuff together, here we are, we're at that lower band. And I'll talk, obviously we're going to talk more about that. And what I, initially here was I was just watching like, okay, these things are turning. And sometimes you hear this about, in our trading room, like there's a methodology for, the fishing pole, and you're looking for the hook higher. And that's kind of the idea here, is that all these are starting to hook higher. And then you're looking for the slingshot, back up to the 21. And I like this visual, but there's a couple things here where I thought it was making it a little tricky, for James here. It's like, okay, how do we make this a little bit easier? And so we wanted to be able to kind of, pinpoint these intraday turns as precisely as possible. We wanted to have ongoing confirmation that the trade is still okay to be in, visual assurances that the decision was correct, visual cues to tell you when the trade is ending, with the underlying theme that consistency was key. Again, that was a big part of this, is we're not looking for big trades. We're just looking for consistency. Make your money and get out, get those quick hits, no hanging around. So then what we did is color coded the lines. All right. So now it's like, okay, if they're all turning higher, then, these will be, the bars will be like lime green. And if they're lime green, it simply means that they're all going higher. And then if it turns from lime green to a little bit darker green, that means they're starting to turn. And then obviously red, they're all going low. It's like, okay, so visually that's nice. I can kind of see in the bars here that everything here is pointing higher, and that certainly helps. But it's like, okay, but again, how do we make this as easy as possible? And then this slide here just kind of tells you what all this means. So if there's 6 out of 6 oscillators that are rising, you're going to have lime bright green. If there's 5 out of 6, it's going to be green. And then 4 out of 6 is going to be dark green. Okay. If 6 out of 6 are falling, it's going to be orange. You can change that to red if you want. 5 out of 6 is going to be red. And then 4 out of 6 is dark red. Any other condition is going to be gray. So like if these conditions are hit, those will be the colors. If it's any other condition, which basically just means it's more mixed, then it'll be gray. And so if you look at this, you'll see, oh, that's gray, because it's like some are up and some are down. And it just means that gray is kind of like there's not a lot of conviction right there. So the colors were helpful. They were a step in the right direction, but I still needed to have something that was brain dead simple for my son to use. And so we spoke again, and that's when we started adding some arrows. And I thought this is where it got cool. And basically it's like, okay, if this one crosses the 0 line, give me an arrow here. And if this next one crosses the 0 line, I want to see another arrow. So now I can say like, okay, gosh, we're down here at support, and, we're starting to see some signals here. And then there's another arrow. That just means another one is crossed. There's another arrow, another one is crossed. And it's just a great way to have confidence that you're in the right trade. The bars are green, they're not turning red or anything like that. And then, now what I have found is that by this time, remember, we're just trying to get 40%, right? If we sell a spread for 450 and we're trying to buy it back for whatever, 225 or whatever the number was, 275, typically by this time we've hit it. But if we haven't, or if you don't want to use that arbitrary target, then this is the no-brainer, I'm done with the trade. Okay. So we talked earlier about stops. And so if you see the arrows and you sell your spread here, and it's like, well, I sold a $10 wide spread, at 450. That means my max risk is going to be 650. Do I place a stop on this? And well, your stop is, if you get in, right, and then all of a sudden they roll back over and you get a down arrow, you just get out. So we're not going to hold for max loss. Typically by this point, your target would already be hit. But if for some reason it's not, at this point, you would get out. Now, ultimately, the market pulled back. It held okay, and eventually rallied, but I'm not interested in that, right? I'm not interested in this part. I'm interested in the snapback. Now, of course, this will be easier when you see the moving averages on here because this was a snapback to that moving average, right? And then we're done, and then we're waiting essentially for the next, the next trade to do that. So yeah, when I'm getting into spreads, I hit the midpoint. So I'll see that the arrows are setting up, and maybe and it's not, the SPX is super liquid. The spreads are tight, and it might be 425 by 450, and I'll just get right in there and do it. You can do market orders as well. I tend to do limit orders. 550. Yeah, thank you. The math. So this was cool, and so James started doing this trade. Now, like I said, I wasn't going to try to teach him options, and he agreed. He's like, no, you know what? Let's just do spiders. I'll do 50 shares of spiders or Tesla or whatever, UNH, and that's how we started off. And he eventually built up to 100 shares once he got confident, and that got him off and running. And this is what he used for like most of the summer, and he would just typically trade for a couple hours in the morning. And so here's like the trades he would do. Now, for a while, he had the oscillators on, and then at some point he just turned them off because he's like, I'm fine with the arrows. I personally like the oscillators. I like to watch them. But he would say, oh, great, I got some arrows. I'm going to buy, and then I'm just going to hold on until I see the red arrow. So on this day in GameStop, he did his 100 shares. And before, he started off, he would just have a target. Then he's like, well, you know what? I think I'll wait until I see the sell arrow. And in this case, it was $421. And I was like, all right, okay, that looked good. And then UNH, same thing. He bought it, and he got out at the close, but he never got a sell arrow. So, but he didn't want to hold overnight. And so same thing. He's just like, all right, so here we are. And so that was he kind of kept it pretty simple. And what's not on here is that moving average, but he would watch that and just kind of that snapback back to that key 21 period EMA on the 30-minute chart. So that was pretty good. So that was pretty good that way. So I was having a lot of fun with this. I was learning a lot from watching James as well. And what was interesting about him is that, I'm watching all this stuff like, oh my God, the FOMC meeting, and then there's this, and here's this data. He just didn't care about that. He's like, what? I don't know what that is. So he wasn't worried about that. He's just like, give me $100 and then I'm going to go swimming or I'm going to go practice soccer. And I really got to the point where I love that, because I'm like, but James, what about the close? He's like, what? I made my money already. I'm like, oh, right. Okay. Good call. So, and look, I can definitely take a deep dive into some trading topics. I like the macro, what's happening over here. What does this mean? But at the end of the day, let's face it, it's about making money and doing it in a way that doesn't cause stress. And that really kind of hit me this summer, where it's just like, well, so what if I don't trade gold? Who cares? It's just like, did I make the money that I was trying to make? Yes or no? And at first I was just happy that I found something that would work for him and that we had a project that we could work on together. But then at some point along the way, I started going like, you know what? I mean, obviously, I'm not going to, for me personally, trading 100 shares of SPY doesn't sound that exciting, but could I trade a couple thousand shares of spiders? Or better yet, what about the SPX options? And of course, we've already talked about the SPX options, but I really got into that and was pretty excited about doing this in a way where I could take advantage of setting up slightly larger goals for each day, but doing it a little bit more conservatively with the spread than trying to do something directional, trying to hold something for weeks at a time. And that genesis all kind of happened at the same time. So the last piece of this that I asked Eric about is that I really liked the arrows. So the arrows kind of indicated when one of those oscillators crossed zero, but I'd also kind of like, so here's the zero line, right? But I'd also like to know kind of like when it starts to hook up. It's like, oh, when does that hook start to happen? And then this is where we kind of came up with the concept of the dot. So the dot is just a heads up, and it's simply a heads up that things are starting to rotate. Okay, so if we come over here, again, we're coming down, we're starting to see some green dots here. What does that mean? That means that some of these are starting to turn higher. And then when we see the arrows, we get our first confirmation. Great, we can get in, typically. And then what's great about this is like it's going, oh, there's another arrow, oh, dots. So typically when you see the dots, that's a sign. You can see we're starting to roll over here, and then shortly thereafter we get, that zero crossing. So what I find here is that this is nice because the dots can kind of get you in early and they can get you out early. You don't have to use them strictly. I kind of like to get that arrow. It's like, hey, let's get the arrow on the way in. But on the way out, the good news is typically since you're using a spread, a lot of times when you see this, you're kind of close to that target anyway. And then if you're not, that's kind of a sign of like, well, let's ease out of this. So, on that. And then, on something like this too, and again, remember, this what's not shown here is that moving average is when you come into a key moving average like this and you start to see sell arrows, then you can sell that call credit spread. In this case, you had a nice kind of a plunge here into the lunch hour. And same thing here, when you see the green dots, it's telling you that we're turning here. And so it's, if your target isn't already hit, then it's time to get in. So now what for me is just kind of a nice ebbing and flowing. And then when you overlay, the moving averages onto this, that kind of gives you some visuals. And so the thing about it is you don't, what's nice about this is that this is, the crux of what we're talking about today is this. This is kind of like, okay, we got the dots and the arrows, and that's telling us that we're ebbing higher here. And then now we got the dots and the down arrows, and now we're kind of ebbing down, and then we kind of, roll back up. And now, so we're trying to just stay on top of those ebbs and flows. And then by adding the moving averages and the Keltner channels, that just kind of gives us a little bit more defined playing area. But you don't need them, honestly. But I personally find them useful. You can kind of make it, whatever kind of floats your boat that way in terms of how simple it is and stuff like that too. Now, yeah, so does it only work on the 1 minute chart? No. So yeah, we'll talk about the time frames and stuff like that too. So a lot of this boiled down to tracking the intraday ebbs and flows in such a way as to make them easier to read. Okay. And then really a big part of this was just, I kind of was getting over sitting through long retracements against me. I'm kind of over that. I'm like, you know what? Let's just I just want to catch these moves. I don't want to hold on to something for, 3 weeks and have it go like this huge dive against me and then hope it comes back, that kind of thing. So it's really just kind of flowing in and out of opportunities. And, I definitely like to look at some of these where I'm in, typically I'm in a trade for seems like about 30 minutes to 90 minutes. But I also will do some overnight on the slightly larger time frames. Now, this next trade was a good eye opener for me. So on this particular day, I was pretty bearish on the markets. I was looking at the daily charts, and because of that, I had bought a put debit spread. I bought the $10 320 put, sold this one fully expecting the market to crash, and you can see that I bought this at 625, and here it is at $1.48, and I'm basically getting my head handed to me. And you can see that the market exploded up here. James, on the other hand, threw on his 100 contracts, made his a couple $100, and he was done. So what was going on here? So I was looking at this. He was looking at this going like, oh, there's up arrows. I need to buy the shares. And, I was looking at this as, oh, we topped out here and I got to buy some puts because we're going to roll over and die. And so, by looking at that larger time frame, I was subjecting myself to a lot more kind of like guesswork, frankly, versus like, oh, this is what's happening right now. And that was kind of an eye opener for me. I'm like, why do I need to sit through this on this trade for a week to prove that it's going to work versus just setting this up in such a way to grab the cash and move on? And so that's what really what it hit for me. So the short version is I started to use the system for myself. And since, of course, I was interested in making more than $100 a day, I started playing around, initially with futures. And, NQ future, here's the Qs, got the sell signals. I shorted the NASDAQ futures. I bought puts on the Qs. I did a call credit spread on the NDX, and it was great. They all did well. And SPX as well. And so what I found with this is on the NDX especially, is the NDX is fantastic when you're right, but it's really sucks when you're wrong. The NDX is just, it's illiquid. The spreads are $8 wide. And if you're right, it's great. But it's, even if you're right, it's hard to get out of. And if it's wrong, you're getting fleeced. So I kind of, to keep it simple, have kind of stuck with SPX. It doesn't mean I won't do NDX trades, but again, why add all that extra aggravation? And then personally, and like we've been talking about, is that 1, 2, 3, 4, and 5 and 10-minute layout. I wasn't a huge fan of that for taking signals, and so I kind of use this as my heads up chart, and then I use a slightly larger time frame for my entries. So let's see, we got that. Okay, so real quick here, what I wanted to show you, because this is an additional tool that comes with the pro version of the class, which we'll talk about next week during the live trading, is the one last question. I was just wondering, like, okay, is there something, if I want to do something more directional, is there something that's faster? And of course, playing around with this, the 2-line MACD set at 310 is essentially the fastest one. You can see here, this is going up. This is already rolling over. It's already giving you a heads up that this is going to die, right? And so I had Eric code that up as well. And, again, it's just taking, instead of, here's the MACD 2 lines, and instead of looking at, 6 different charts and going like, oh my God, what's happening? I just had them combine them. And so now here is the difference between the squeeze rotation and then the trend rotation, which is those faster ones. And you can see it's very similar. So here, all this is rolling over. You get the dots, you get the heads up that it's rolling over. Over here, you get the arrows a little faster, is what I found. And so sometimes that's nice. So like right here, when it's turning higher, you can see that, okay, here it's pretty clear that this thing is rolling higher, right? Here, it's pretty clear that it's rolling over. So it's kind of, it's the same idea. I mean, you can see like right here, I mean, it's similar, right? It's just that this one's just a little faster to respond. And that's the only difference. You can, especially spread trades, you can totally do it with this, but that's the main difference, is this is just a little faster to respond. And that's that one. And then there's the 2 different versions of that. There's what's called regular rotation, and then SD rotation. And what that means is standard deviation. The only reason for that is that with the regular, you're going to see like, okay, this is minus 40. And you can see these levels are a little different. Well, it's because that it's measuring, it's measuring each time frame. And, in this case, the hourly time frame is all the way down here at minus 40 on the 5-minute chart. Well, so and talking to Eric about this, he's like, well, if you set everything at a standard deviation of 2, it'll be a little cleaner. So now, you'll see again, it's just kind of like, okay, like you can see, from Friday, we had this little move back up to the 8, there it is. So again, not a huge difference, but don't worry about these. So these we're going to talk more about during the pro class on Wednesday, because that's the piece that was included with the pro class. So otherwise, everything's the same. But that's a couple of people had asked, like, well, is there a big difference between these? And it's not a huge difference, but I kind of appreciate, sometimes the subtleties there, just depending on, what you're looking at and what you're trying to trade there. Okay, so now we are into part 5, which is the setup. Now, the setup part of this is today, but a large part of the setups we're also going to be doing during the live trading. Now, don't worry, if you have not signed up for the live trading, that's fine. All the setups that I document during the live trading, I'm also going to upload here. And if you're just doing this package, you'll be able to see those documented setups as well. So the setup portion of this is going to be ongoing over the next couple weeks while we're doing the live trading together, and then they'll continue to be updated. Okay, so we're going to start it off today kind of light, kind of get a general idea of some of the things that we want to look at, and then we'll be heavily documenting the additional setups. Ideally, what I want to do is the setups that I like. I want to be able to do each kind, both bullish and bearish. And then if they don't happen during the live trading, then I would document it outside of that, so you guys can have specific examples of each one like that. Okay, so All right, so how do we put all this together and make this easy to do? All right, we've talked about the moving averages, the Keltner channels, the percent from the moving averages, and now we looked at the rotation tools to help us gauge when something is about to turn. So the first thing to remember is, as humans, we tend to make things way too complicated, okay, and way too precise, T-O-O, precise. Remember, this is simply a tool to identify turns back to the intraday mean and utilize the benefits of 0 days to expiration SPX options to our benefit. So first, let's look at Friday's craziness. All right, so again, this is the standard chart. I like to look at the 30-minute chart, the 5-minute chart, and the 1-minute chart. Okay, so the 30-minute chart is bigger picture. I'm going to have the 21-period EMA off the daily, the 8 EMA off the daily, and the 5 EMA off the daily. Okay, and you can see that that's the 8, that's the 5. I'm also going to have the daily Keltner channels imported into this with the 3.0 ATR. Now, guess what? If the VIX is quiet and drops back below about 25, I will change that ATR to 2.0. Okay, 2.0 is kind of the standard, but when the VIX is over 25, guess what? The volatility increases, and then 3.0 is better off of the daily. For the hourly, I always leave it at 3.0. So I can look here and say, like, okay, so for here then, this squeeze rotation. Now, so by the way, if you have a 30-minute chart and you look here and you don't see anything, it just means that all the time frames that you have filled in are below it. So the only things that's going to show up, and the only reason I have a 1-minute chart here, I'm frankly not too interested in the 1 minute. Okay, but I do want to see how the 1, 2, 3, 4, 5, and 10 all work together, because the 1, 2, and 3 is a good heads up for the 5, and it's a good heads up for the 10. So over here, the lowest time frame I can have is 30 minutes. So here's the 30-minute squeeze histogram, the hourly squeeze histogram, okay, and it's all listed right here. The 2-hour, the 4-hour, the daily, and the 2-day. So that kind of gives me a nice overall, not surprisingly, they're all below zero here, right? And so for this particular one, could you do a swing trade off of this? Yes. Guess what? So we got green dots here on Friday, right? That's a heads up that we're seeing some rotation. If I wanted to do a butterfly at the 5 EMA for Monday or Tuesday, the 5 EMA gets tested multiple times a week. All right. So if you're familiar with butterflies, you can do that. You could do an out of the money call debit spread for the slingshot back to that level. So when I'm doing something like that, like a far out of the money call debit spread, this is the chart I'm looking at, because that's a trade that I could hold on to for a couple of days. Typically, it's going to be lower risk since it's out of the money. If it doesn't work, not the end of the world. All right, so that's how I use that, but I also kind of gives me a bigger picture of what's going on. You can also, if you've got other tools, you can add RAF Pro, you could add the Squeeze Pro, you could add the Voodoo lines, right? So this is the chart where I would add any of that other stuff, quant pivot levels and all that kind of fun stuff. So that's that one. And then let's see, and then for the middle chart here, and the yeah, so good question on you can also, if you want, and I added this on here, I don't necessarily watch it all the time, but I know a lot of people like it. Those pink dots, that tool's included in there where it's that ATR trailing stop. All right, on that ATR trailing stop, you can turn it on or turn it off. Some people find it useful on here because we've already got dots. It could probably get kind of confusing if there's too, you don't want to have too much stuff. But if this is something that you like, it's already teed up and ready to go. And there you go. And so the idea with this is like, okay, if the dots are above price, you keep the downside pressure, and if they turn blue and all that kind of stuff, if you're familiar with that. So I like it, but it's again, it's just, I know it's one of those where it's nice to look at and all that kind of fun stuff. For now, I'm just going to uncheck it. It's there. Okay, there we go. Okay, let me turn it off on here too. Okay, there we go. All right, so okay, so that's the 30-minute chart. So on the 5-minute chart, so the 5-minute chart is my main chart that I use. So of course, as I'm, this is where I'm spending most of my time. I've got the key moving averages. I can dial in on them. They're pretty close. I get the bigger picture over here. Obviously, on Friday we're in a downtrend. I do think it's a good idea, like on the SPX. I'll typically add horizontal lines at the big round numbers, 3,700, 3,800, 3,900, and the half levels too. A lot of times those do act as, support and resistance and things like that too, just because that's where a lot of the option activity is. Remember at the beginning of this, and we talked about how SPX options are kind of driving the market. Guess what? It also becomes a magnet, because most of the time when hedge funds are hedging, they're not doing the 3785s or the 3690s. They're like, do the 3700s, do the 3650s, those bigger levels. And so they do become magnets. So on Friday, so you can see on something like this where, we just kind of open up and we do get this little snapback rally to the falling 8, right? It was pretty quick, but the downside pressure maintains. But once we got to the end of the day here, you can see that, that some of the first green arrows we got, and then we didn't get any sell arrows the entire close for that last hour. So even though it was a pretty ugly day, the S&Ps rallied 43 points into the close. And yeah, you can see here, it's like, okay, geez, we got all these turning up. And generally here, like these red dots, yeah, they're a heads up that it's turning. But what we're interested in here is the arrows. The arrows are kind of, and I've got a specific thing I'll show you where I'm like, okay, if I get the arrows here on the 1-minute chart, we can get on over here, but then I'm not going to get out until I see red dots on this chart, et cetera, because it's anyway. So it all starts to kind of come together that way. And now one thing here is sometimes you might set up your charts and it's kind of like, man, it's kind of hard to see the price. You see like all these, here's the Keltner channels, here's the moving averages, but the price is so tiny. So what you can do is just make sure that, at least on Thinkorswim, is I go into the gear button here and then price axis, and then and these normally are checked. And so I just uncheck those. So I uncheck fit studies and fit study markers so we can focus in on the price. Now I will add these expansion areas. I'll put 10% up and 10% down, because sometimes if it's a big down day, what'll happen is price is like at the bottom of your chart. Like you can't see anything, but like price would be like right here. And that to me is kind of confusing, because, it's like, well, at least I want a little bit of a range there. And then same thing on the upside. I don't want it, if it's making new highs, that's, essentially the top of the chart is resistance. And so by doing that, then, so again, without that, what happens is that, yeah, you're going to have, this is going to be expanded to see all your indicators, but do you really need to see that the top of this is at 3850? Do you need to see that this is here, right? And if you want to, that's fine. But what I like to do is I'll compress it so I can zoom in on the action. So I can see, especially, again, remember that important one is that 21 EMA from the 30-minute chart. And if we're down here and we're far away from it, we're getting these arrows, I'm looking for a snap back to that route, snap back to that level. And so that's the kind of stuff that I'm looking at there. Yeah, well, remember the arrows are, so what you're looking for here is when you get to a support level, remember, you're looking for the green dots or showing you that you're getting the turns. That's when you're establishing the trade. By the time they get the green arrows, you're already positioned, right? And then from there, to get out, you're looking for red dots. So remember, so I have a saying here in trading, which you got to be, you always want to be careful. Make sure you're not a confirmation whore. So sometimes traders are like, oh, I got 20 things and all 20 things need to line up before I get into the trade. No. The arrows are telling you, remember what I talked about. You want to be on the right. You want to be sure that you're on the right path. Okay. The signals here are on the 5-minute chart of the dots. You're more than 1% away from the 21 EMA. You're at a level. You're starting to turn. Great. Let's put on a spread. Then how you're on the right path? Okay. Oh, we got the arrow. Cool. We're on the right path still. Oh, there's another arrow. we're still on the right path, right? Oh, we're yellow now. We're on the, because now everything's moving higher. So those are all there to tell you that you're on the right path. Okay. So that's we want, that visual kind of safety of, did I make the right choice? But if you're waiting till right here to get in, you're absolutely missing the trade. So, okay, we're down at a level, we're 1% away. It's scary. That's why we do spreads. You buy futures, you could get hammered. You do a spread, you can take a little heat against you because it's not going to move very much. And that's why we do in the money spreads. Let's see. No, so should it be the 55? No, I actually did the 50 on this one. I do the 55 on the daily, but this is the hourly chart. And whether it's 50 or 55 is fine. It's one of those on the hourly chart, not as, it's just more of a zone. All right, so what about the 1 minute? So, what about the 1 minute chart here? So the 1 minute chart to me is the heads up. So typically what I'm doing when I'm getting into a trade is, if I see the dots here and we're against, a key level, oftentimes that's enough. But if I'm looking for something to get in, I like to see that we at least cross on the 1 minute chart. So if we get an arrow here, yeah, we've already moved 12 points. The arrow won't show up on the 5 minute until much later. But if I see the dot on the 5 and an arrow here, I'm in. And especially if we've got that falling 21 EMA. All right. So this is the Snap 2 trade. And again, it's just like, great, let's sell an at the money credit spread. And we're going. And then as long as you see these arrows, it's kind of like, okay, I'm on the right trade. The red dots are showing you that the smaller time frames are starting to turn, not the end of the world. What I'm looking for an exit is, do we get a red dot on the 5 minute? So, and I've got this all listed out. So, but that's kind of how I'm looking at this. But a lot of times these are the visuals to help you understand, are you on the right side of this trade or not? And that's what I like about this, is that, because sometimes if you've ever been in a trade and it's like, oh my God, everything just rolled over and died and it came out of nowhere. I just want to see what's happening. Are we rolling over and dying here, or what is happening? Yeah. So, and so we'll look at, so the two main types of trades here, right? So there's snap trades. The snap trades are when we get God, I've done that twice now. It should be you get too far away from the moving average and you're looking for a snap back. And then rollover trades, where after snapping back, it rolls over into the direction of its prior move, right? And those are the two main trades. So the snap trade. So here's an example of a snap trade, and we'd be selling a put credit spread. So again, in this particular case, so the snap happens when price gets too far away from the 8 EMA on the 15-minute chart and or the 21 EMA on the 30-minute chart. Typically 0.75% to about 1.25% is what I've found. I'm fine at 0.75%, okay? And at that point, it's like, okay, let's see what's happening here. I then start to look for turns in the histograms on the 1 minute chart. Okay, that's the dots. That's typically what's going to show up first. And then I want to see an early arrow on the 1 minute chart as the 1 minute histogram crosses the 0 line. That is enough to enter an at the money put credit spread, as long as these conditions are met. We're at least 0.75% away below that key level. And I'm starting to see dots on the 1 minute chart, and then an arrow on the 1 minute chart. Oh, actually, let me see here. Since I can do this now, get too far. The histogram on the 1 minute chart, multiple dots, and at least one dot on the 5 minute chart. Then an early arrow on the 1 minute chart. Okay, there we go. Save. And then we'll look, you know, picture's worth 1,000 words. So we'll get to the charts here. All right, so I'm starting to look there, and that's enough to enter the put credit spread. So remember, the put credit spread is in this case, is forgiving. It doesn't need to be perfect. You're just looking for a couple of conditions, and it's like, okay, that now it's at least safe to put one on. Then what I want to see is then I want to get that visual. Okay, so I put on the credit spread, and I'm sitting there, and I'm waiting, and I want to see that arrow on the 5-minute chart. Okay, now could I wait until I see an arrow on the 5-minute chart to get in? You can, but the point is that you want to kind of get in as it's turning. And by using a spread is pretty forgiving. And then when you see the arrow on the 5-minute chart, that is the visual that you're on the right path. Okay, you've already got a signal, you've got an entry signal, but the continuing visual that you are on the right path then starts there. So at that point, I know I'm good. I could scale in if I wanted to add more. And, you know, that's where I start, you know, I place my order to exit 60% of the credit received. And either that's hit, and if it's not hit and I get a red arrow, right, and we start to roll back over, then I can just exit then as well. So that's kind of the basis of it. So, you know, picture's worth 1,000 words. So if we're looking at this, it's like, okay, so we've got a gap down. You know, it's like at the end of the day, it's like, okay, gosh, you know, here we got some arrows, we got the dots, we got the 1-minute arrows, and we got the 5-minute dots. Those are the three things in conjunction with being over 1% away from the 21. Great. Sell the spread. Arrows are visual confirmations. In this case, you could have held on to the close, but of course, you know, you're just kind of, you know, looking to make your money and run. Does that make sense? So obviously during the live trading, we'll be doing this live, but that's kind of the idea of like, all right, you know, we're looking, it happens like this: dot, dot, arrow. And then, and sometimes if it's a strong enough support level, the two dots on both are fine. Dots on both are fine with me. So, and then the up arrows are just a visual, and, you know, all that kind of fun stuff. If we look at, let's look at a bearish one here too. So that's the snap trade. The is this? Yeah, okay. So let's look at a rollover trade. So this is a rollover trade. In the direction, the rollover is typically kind of the trend of the day. You know, it's like let's see, get this. Okay. All right. So the example then of a rollover is kind of like this. So we're pushed lower, we get a snap back. You know, here's that snap back to the following the 8 EMA, and then we start to, you know, we're getting arrows like right away, right? Okay, great. Sell a call, and it's against 3,700. You know, sell a call credit spread. You know, we're going. Remember, you kind of, you know, for the exit, like, okay, we got a good visual here. We're going, and then you finally get arrows down here. And then if you look at the 5-minute chart, we got arrows, you know, down here at like 36.75. By this time, you're out. You know, when it's going like this, your premium decay is pretty fast. If for some reason it's not, then you're getting out. Does that make sense? So, and again, we'll have the kind of checks and stuff like that, but it's like, you know, you're rallying back to that 8. You get the sell signals, you sell your call credit spread, you place your order to buy it back at 40% of the credit received. Typically, in a situation like this, by here, it's already going to be hit. If for some reason it's not, or you're like, you know what, I'm just going to wait, then, you know, then you'd be getting out there. Now remember, yeah, so dots versus arrows. The dots are the heads up, So the dots are the heads up that we're turning, okay, and that's typically when a move is about to happen. And then the arrows are, so I look at it as dot, first the dot, then the arrow. So the dots are the heads up that are starting to turn, and you want to see dots. For me, I want to see dots on this time frame. Remember, the 1 minute is kind of the heads up for the 5 minute. So if we're down here at 3650 and we're seeing dots and we're far away from these moving averages, and I know this is a strong support, this is a strong support level, 3650, great. That's good enough. And then I can sell it. And then what I'm looking for is we're snapping back to that 8 EMA. And then as long as we're seeing a visual that it's correct, it's all, there was no exit signal here. So that was great. Let me see. Snap trades. Yeah, so here's another visual here. So this is kind of, and of course Friday was kind of a crazy day, right? So this is a good example here where you gap up, right? Here's the morning, you gap up, nothing's happening here. We don't get any signals. Remember, the 1 minute chart is going to be a lot of noise over here. We don't even get a dot or anything. And then we come up again, and then we start getting dots. Okay, so what are the dots? The dots are the heads up that we're starting to roll over. And if you look at this, it's like, well, remember, what's going to happen? We're going to come back and test this 21 EMA on the 30-minute chart at some point during the day. It happens like every day. Great. We get the dots. We can start selling call credit spreads. We get the arrows. That's a visual that we're on the right side of the trade. And then when we get here, either, it may still keep going, but at that point, our targets typically hit. Okay. If it's not, we can get out. And then there's no buy signal. There's no buy signals here. Here you can see you get these arrows, but remember, we got to be, we want to be 0.75% away from this. So when this is happening close to the moving average, we're ignoring it. We don't care. So we got to see that distance, that distance away, get the signal, we're en route. The 1 minute's going to have a lot of noise. The 1 minute is simply just kind of a heads up, is something about to happen over here. So the 1 minute, I don't trade off of it. I just kind of like to see this one has a lot of arrows. We kind of set it up where it doesn't have that many, but you can see there's like a lot of crossings and stuff like that too. What was the other one on here? This one, what was this one? No. Yeah, okay. I was trying to remember what this trade was. Okay, so sometimes I'll do this, and sometimes it works great. And what I found, though, is for consistency's sake, I don't do it a lot. So on this particular day, the SPX is up strong, and we got a signal to, we got the signal. So I sold a put credit spread, and I sold it for 528. Here it is at 250. It's doing great. It's exactly what I want to see happen. We're up like 11 points. And the premium decay is fast. But I remember on this day, I was like, oh boy, I bet this thing is going to explode. So I'm going to go ahead and buy a call debit spread, for 490. And this thing I had to close it out for a loss. So on this one, I made good money. It was pretty easy money. And on the debit spread, which would have done great had the market exploded higher, but it didn't. And what happened on this day is that the money I made selling the put credit spread, I completely offset on this debit spread. So I'm showing you this example because you can make good money on a boring credit spread. And then if you try to get too cute, you can give it all back. And so that was a particular day where the money I made on the credit spread, I lost on the debit spread simply because I thought, geez, this is going to go a lot higher. So that's ego, right? That's, oh, I think this is what's going to happen versus just doing the easy money. And so I do encourage everyone to I know sometimes it's fun to oh yeah, this thing's going to get crazy. And it was on this day. It was actually on this day. So, so if you look at this, it's kind of like, okay, I'm trying to remember exactly where, but anyway, as it was going up here, I thought we were going to go to 40.50, And this is where it really sunk in that, you know, once you get about 1% away from this, you really have a, you know, you're not going to shoot it straight up from there. You got to, you know, you're going to ebb and flow. And it really made me realize, like, a lot of times debit spreads, you know, in those kind of cases are kind of a waste of time. So anyway, hopefully that made sense. Yeah, I've gone to the pool there. Okay, let me see. What time is it? 3. Gosh, it's already 3:30. Okay. So let me do this. I just want to make sure we've got that covered. Yeah, so here's another example. A couple of examples here I want to show you, just so you kind of get a sense of this. So again, the main stuff here to think about is you want to know which ones to pay attention to. So here, you know, this is the NDX. We gap down, you know, okay, there's a red arrow. So here's a question for you. We gap down and we get a red arrow. What do I do here? We gap down and we get a red arrow. Am I shorting this? Yeah, the answer is no. Yeah, absolutely nothing. So if we're far away from the 21, the only trade that I'm looking for is a move back to the 21. Okay, so we gap down. Great. I'm watching. All right, we get some dots. Okay, we get some dots. That just means we're starting to turn. Here's, you know, here's some heads up over here. And then, you know, and I remember this trade because, you know, we got the arrow here and, you know, and we're against kind of a key level. And I remember selling this put credit spread. This is a 5-minute chart. And then for 5, 10, 15, 20, 25, 30, 35, 40, 45, 50, 55, 60, 65, 70, 75, 80, 85, 90, for an hour and a half, you know, we just chopped back and forth. And it was a little annoying. And then I remember getting like this sell signal, and I didn't quite catch it. But what'll happen like this in this choppy, this is a good example of this kind of a market here where, you know, when you get like this, you just kind of beat around. But at some point, you got to come back up and test this. And so the spread here is just a lot easier to hold on to. You can see these are all moving higher, right? And I remember that trade because it was hard. It was hard to hold on to. You know, it was hard. And then boom, we made it up there. So, you know, one question that'll come up on this is like, okay, well, then do you do like an out of the money call debit spread here with the idea that we're going to come back up to that? And the answer to that is absolutely yes, if you want to do something that's cheaper. The mistake I made over here is that we were going up and I sold the put credit spread and I got enthused that we were going to keep going up. That was my mistake. If I'm going to do a call debit spread, it's because we're under here and we could explode up to here. If we're, you know, does that make sense? So if we're off and running, I'm not going to assume that we're going to get more than 1% away from this. So I'm not going to do a call debit spread further up. However, if we are, you know, under it and, you know, especially if it's later in the day and you can do a cheap call debit spread, great, throw it on there. And if it doesn't work, you know, this is where you could do a call debit spread that's like, you know, $2 on something that's $25 wide. And if it doesn't work, it's not a huge deal, but if it does work, it's great. And so that's where that makes sense if you're going to get that snapback. But the mistake I made there was assuming that this was just going to keep on going. And you don't have to do that. You don't, you know, you just do the easy trade, do the easy stuff. So the main point here is that, you know, as you're looking at this stuff is, you know, the rule of thumb here is that, you know, you want to be about 1% away from this 21 period moving average that's imported from the 30-minute chart. If you are, you know, in a situation like this where you open here, you know, you kind of come up, you know, you're not 1% away, you come back down, there's nothing to do here. Now, if you get here and that's 1% away, then yeah, you have a put credit spread opportunity. You know, so like that. So, and that's the NDX, which of course we don't want to do too much with. The main point here, though, is that you're using that as a filter. You know, you're looking for those snapbacks. The other thing I like to look at, if you are going to get a sustained move, is do you get crossovers across these moving averages? So here, it's like, okay, you know, here's Tuesday, you know, this is the SPX. we gap down, we get the move to the 21. That's great. We come back down, and you're like, okay, great. Let's see if we get another move to the 21. But then you see that the 8-period moving average from the 15-minute chart crosses the 21-period moving average from the 30-minute chart. That's typically a really powerful sign that we're just going to keep on going. Okay. And so that's another thing too, is like, if these are angled upwards, then great. If we flush back down to it, we're going to, we'll buy that and continue riding it up like that. So that's what I mean. It's either going to be kind of that snap trade where it's going to snap back to that level. Okay. Or in this case, that it's more of a, I guess you could call it like a, we pull back trade and continue on its way. So those that's it. That's all I'm looking for, is either we're really far away and we snap back, and then we could potentially look to fade that back lower, or when you get the moving averages in this case start turning higher, great. It's almost like just like buying a pullback. And then I can see here that in this case, this is the 5 EMA from the daily. That's probably going to be a pausing point, or the 50 EMA from the hourly, et cetera, et cetera. Yeah, on this, so some of these charts are a little bit older, and then this one just didn't have the dots activated. So here, let's bring this one over now again. And and if we look at, so obviously those are downtrends here. We could look at something like the dollar, and you can kind of get a see what a a super strong uptrend looks like. And on this uptrend, same thing here. If it's a really strong uptrend, and you can see like the angle of these moving averages is really strong, it's like, okay, yeah, I'm not gonna I don't want to short it, but boy, if we come down to it, I certainly would want to look for opportunities to buy it, kind of a thing. There's not a lot of uptrends in this market. Let me see the VIX. And then the VIX, I've watched the VIX on this, and it's the VIX is more of a function of hedging activity and stuff like that too. But I like to you can watch it because look, if the VIX comes down, likely the SPX is going to rally, which is what happened towards the end of the day on Friday. But I don't trade the VIX. I have traded it before. I just to me the SPX is better. So yeah, it's rolling over, but I'd rather in this case, if it's rolling over, that means the odds of SPX are going up. Then I'll look at that. Let's see. What was the other one I want to look at here? UNPH? No. Oh, snow. Yeah, so snow here is interesting. So this is one that's been holding up pretty good. And if we look at it, we can see that, okay, it's kind of trading below its 5 and 21 and 8 EMAs on the daily, right? So yeah, the odds are that we get a snap back into that. And then you can see, I mean, it held up pretty good compared to all the carnage that we saw. And but same thing, if if you're just like, well, I just want to trade, and you can see here it's like, okay, we got to that upper band and just died. So that's the sandbox, right? That's the sandbox. Then we came back down to the 21, and then we got back up, and then we came back down, and then of course, the market died and all that kind of stuff. So, whatever you like to trade, I mean, this kind of, you can kind of plug whatever it is that you're looking at. If we look at the Qs, I mean, obviously the Qs here are kind of moving with the rest, S&Ps and the Qs. Same idea, all that kind of fun stuff here. What about the futures? The futures obviously are kind of nice because you're going to get those 24-hour levels, and you can kind of see like the futures, especially at the open, kind of give you some information that you may not get with the cash index. So I like to watch both. You can just riding that 21 down, like here's those arrows, you're just riding it down. So on something like this, when we're just rolling over here, it's like, okay, well, I don't necessarily want to fight it. But you can see when we get to the Keltner channel, yeah, we get a bounce there, right? We do get a bounce, but it's like, this is a day where it's like everything's falling apart and all that kind of stuff too. So part of what I look at too is what is the slope, and maybe that's something we need to put on there is the slope of the moving average. If it's If it's negative 45 degrees, then, we're going to be shorting rallies to it, or if it's positive 45 degrees. So there's a couple of things like that, to look at as well. Yeah. So does this work for currencies? Let's look at, I'll just, throw on the yen here. 6J. So on the yen here, I haven't traded the yen in a while. So you can see this is the 5 EMA on the daily chart. We kind of stop dead in its tracks. It's the same idea. It's the same idea here. And it's what was the other one? Well, we looked at the dollar index and, the euro and all that kind of stuff too. It's the same thing on the euro. It's like, gosh, we rally up here, we get the sell arrows, bada boom, bada bing. So, once you kind of get when you get the hang of this stuff, then it is kind of like it's interesting right now, and it's actually going to be good doing the live trading because we're at such an extreme right here. I mean, most of the time we're kind of at, it's more of a, like a quieter kind of a market where and by quiet, I just mean that it's like, oh yeah, we're still volatile, but it's not necessarily, straight up or straight down, but either one's fine is the thing there. So either one's fine. And so you get, certainly some interesting movement this week. I've seen stuff like this pretty common where you gap down, you get the arrows, you get up to the 21, your target's hit, and then, you get extended too far. This doesn't happen a lot, but you got snaps on both sides. So first you got the snap to the 8 here, and then you got the snap back to the 21, and that happens too. And so what's nice about this is you're not really worried about catching every move. You're just kind of like, oh gosh, we're 1% away, and all that kind of fun stuff, even in the midst of all this craziness. Okay, so let me see here. I want to make sure there's a couple slides here I'm going to update, but let me make sure that we've got. Okay, yeah, so here's the other reason I like this. And so for those of you that have, if you follow some of the swing trades and stuff like that I've done, this is a daily chart of the SPX. Okay, and I remember this day because like we'd come down, we were at -2 ATR, and I'm like, oh, we're probably going to revert back to the mean. And so, and I remember that's the trade that I focused on at the open. I was like, okay, I'm just going to buy, I'll sell put credit spreads at the open using the daily chart, using this chart. Okay. Now I lost money that day. And so then when I brought up this 5-minute chart, because I wasn't watching it this particular day, that's when I was still kind of playing around with it. It really, really struck me like how the daily chart was kind of tricking me. Like, oh, we're down on the daily chart, we should snap back. And so, here we got this little rally, basically back to the falling, 1% snapback. And then we just kind of continued on lower. And there's no reason for this to rally if it can't even get through that 21 EMA, right? And now, okay, great, we're 1% away. Great, let's sell a put credit spread back to it. But that's all we're expecting. And so that was a real aha moment for me, because I would look at something like this and to say, oh yeah, we're at -2 ATR. The odds are we're going to go back here to the mean. But this was helping me really drill down and say, oh geez, no, that's not what's happening. And now that I've been using this more regularly, it's like, okay, yeah, we gap down, we get the arrows, we're 1% away. Yeah, I'm going to sell a put credit spread, and then get out with the red arrows. I think by this time, your target's going to be hit. It's already moved 30 points. And then it's like, great, yeah, let's sell some call credit spreads, and boom. And so for me personally, I've found that it really helps me stay on the right side of the market there. And that's been a huge aha for me. I mean, usually I'm fine kind of sitting through multi-day moves against me off of the daily chart. But after sitting with James and watching him knock out that $100 a day, I kind of started to question myself, is like, do I need to really do that? Now, that doesn't mean that, one of the trades I want to set up during the live trading is, look, if we're still going to be 3% away from the 8 EMA, hey, I want to throw on some cheap debit spreads for some move back up to this. I think that's totally fine. We could absolutely sell some put credit spreads too. But that is the kind of trade that I wouldn't mind putting on for a couple days. You know, once you get X% away from these, they get pretty cheap. And of course you could do butterflies and stuff like that as well. Okay. So let me do this. So I'm trying to, I think we can push through it. It's already 3:40. So let me cover a few more things. And then I was going to turn it over to Lorna so she can kind of show you where some of the things are in the folder and all that kind of stuff too. Oh, where do you turn dots off and on? I've seen that question a couple times. Okay. So if we come over here, that's a good question. So we go to studies, edit studies. I always forget if it's the bottom one or the top one. So I have zero line filter on as no. Okay. And then on the top one, the turn threshold, I have it at 5. So what that means is that the turn threshold is that if it has to get below 5 to do it. And you'll notice here, so it's sometimes it's a little weird because, all right, well, geez, on the downside here, we're way below 5, but on the upside, so sometimes, you can modify it. But if you come over here to the 1 minute, it's like, okay, well, if you get, you could get turns at 10. So one of the ways we kind of fix that is using that standard deviation version. Then you just do 2. But that's how you get the dots. Good stuff. Okay. So a couple things I want to show you then. So one of the main things here is just kind of keeping in mind the goal, what's the goal of this, right? And the goal of this is traders are not born with the patience gene, and they have to learn it mostly through brutal lessons. One of the things I found in doing this is that I'm able to sit and relax because I'm not worried about, oh my God, what if I miss this move? Because I've got really specific things I'm looking for. Like, okay, we need to get a certain percent away from that moving average. And then I need to see some dots. And then I'm going to put on a spread. And everything's kind of low stress. And it doesn't mean that everything works right away, but it's just like, it's not, it's a lot different than going, oh, I got to, am I going to miss this? Or no, because I've got specific thresholds that I'm looking for. So that's what I found there. And this to me is just a really nice, clean representation of, the ebbs and flows. And it's like, okay, we get the arrows, you can see the oscillators, and, we're just kind of cruising along here. And as long as it's appropriate to be in the trade, it's going to keep you in the trade. And then once there's, it's starting to see like some rollover here, it's like, okay, well, there's a dot. That's your first heads up. It doesn't mean you have to bail, but it's a heads up. And then there's some more dots. It's like, okay. When you see the arrows, though, it's kind of time to get out. I mean, at that point, it's all she wrote. But the good news is with the spread, because our targets are pretty modest, typically your target's already hit when this happens. But if it's not hit, that's when you just get out. Again, it's not, you don't need to scramble or anything like that. You just kind of, ease out. The nice thing is because you're selling, in this case, selling put credit spreads at the money, you're benefiting from theta decay even while it's up here chopping around. So that's nice. And then, if this does get a threshold, the moving average isn't on here, but if this was the 21 and we're this far away from the moving average, then you can, sell call credit spreads and ride it back down as long as the signals are telling you that it's okay. And what I like about this is just like, okay, if the signal is telling me that it's okay to be short, it's okay to be short. It's okay to be short. It's okay to be short. It's okay to be long. It's okay to be long. Remember the colors like this, it means that the oscillators are still going higher. And then this is just a heads up that it's ending. The party to the upside is ending. And and it's so in its cleanest version, it's kind of nice. It's kind of nice like that. Okay. And it is what I find this is such a true quote, right? The mind is like water. When it's turbulent, it's difficult to see. And when it's calm, everything becomes clear. And of course, and I've always mentioned this before, and it's just that, you always hear about the magic of compound interest. And, for a long time, that compound interest was less than 1% a year in your bank account, right? And now, okay, maybe it's 3% a year now. I don't think they're passing that on to us yet for savings. But let's say you had an interest rate of 3% a year and you were going to compound your account that way. I mean, that's great. But what if you could do 1% a day? Okay. What if you could do 3% a day? And that's where the idea of doing what I simply would call conservative day of expiration spreads. You're not making big directional trades with the futures. You're not, having a lot of exposure for weeks at a time, and just take your money. And what really hits me is it's like, say you have $100,000 account. Like, I know we're all trading different size accounts, but if I don't have a goal like this and I make $1,000, right, that's 1%. I'm always kind of like, well, geez, I could have made 2,000. I could have made 3,000. Where's the next trade? And then I might, by the end of the day, I'm down $1,000 because of that stupid mental chatter, versus going, you know what? If I can make my daily goal and I have discipline, and over the course of a year, where am I going to end up? So all of a sudden now it's like, that's pretty attractive. And I've just found that it kind of naturally brings in a better discipline as well. It's like you don't have to catch every move and all that. So all that stuff, I think is pretty important. So a couple things I included in here for those of you that are newer is on toward the end, there's a section on squeezes, and I know a lot of you already know what that is, but if you don't, the classic squeeze is something where it's like, here's a compression of volatility, you release that volatility, and there it goes. And so some of the things I'll have on here, sometimes on the 30-minute chart, I might add the squeeze, right? And so that's just some information on the squeeze. And remember too, the flow of the markets, you're going to get that thrust, and then you're going to get the reaction move. And this is just a way to play those using the combination of moving averages and those rotations. Different patterns like that set up, and it's always good just to kind of see that naturally play out.